Hello, welcome back to Hungry for Moat. This is 1964 Part 2. So we did some research and we found out that it was April of 1964 that his dad passed away. So he's probably already merged with Berkshire Hathaway Holdings, and he's still managing this private partnership on the side as well, BPL, and this is the second part of 1964, and let's get straight into it. Okay, our performance in 1964. Although we had an overall gain of $4.8 million in 1964, it was not one of our better years, as judging by our fundamental yardstick, the Dow Jones Industrial Average, hereinafter called the Dow. The overall result of BPL was plus 27.8% compared to the overall plus 18.7% of the Dow. The overall result of the limited partners was plus 22.3%. Both the advantage of 9.1% percentage points on the partnership basis and 3.6% of the limited partnerships were the poorest since 1959, which was a year of roughly comparable gains for the Dow. Nevertheless, I was not depressed. It was a strong year for the general market, and it's always tougher for us to outshine the Dow in such a year. We were certain to have years where the Dow gave us a drubbing, and in some respects, I feel rather fortunate that 1964 wasn't the year, because the problems that galloping markets posed for us, a Dow repeat in 1965 of 1964 results would make it most difficult for us to match the performance, let alone surpass it by a decent margin. To bring the record up to date, the following summarizes the year-to-year performance of the Dow, the performance of the partnership before allocation to the general partner, and the limited partner results. So you can see here, 1957 to 64, comparing the overall Dow, which is averaging close to, I'm thinking, around 10% compared to the partnership and the limited partners. So partnership meaning what he would get without fees, with the fees included, and then the partnership letter results is what you would get as an investor with the fees removed. On a cumulative or compounded basis, the results are here. Okay, so this one really compares it. At the bottom, we should see annual compounded rate. Here we go. 11.1% is the Dow. With what Buffett gets with the fees added on is 27.7%, and what the general partners would get, as maybe you would be if you were to invest in Buffett, would be 22.3%. So pretty much on the dot 2xing what the Dow is doing. So pretty incredible returns there. Yep. Bravo, Buffett. Okay, now let's see. So investment companies. We regularly compare our results with the two largest open-ended investment companies, mutual funds that follow a policy of being typically 95 to 100% invested in common stock, and the two largest dividends closed-end investment companies. The four companies, Massachusetts Investment Trust, Investor Stock Funds, Tricontinental Corporation, and Lehman Corporation, manage about $4.5 billion, are owned by about 550,000 shareholders, and are probably typical of most of the 30 billion investment company industries. My opinion is that their results roughly parallel those of the overwhelming majority of other investment advisory organizations which handle it in aggregate vastly greater sums. The purpose of this tabulation, which is shown below, is to illustrate that the Dow is no pushover in an index of investment achievement. The advisory talent managing just the four companies commands annual fees of over $8 million, and this represents a very small fraction of the professional investment management industry. The public batting average of this highly paid and widely respected talent indicates performance a shade below that of the Dow, an unmanaged index. Again, he's touting that, don't put money into these crazy mutual fund guys who think that they're these fancy investors on Wall Street. If you just put your money in the Dow and just be quiet and do nothing, you'll get greater returns. Or invest with me, because I'm really killing it. Let's see, compounded, let's see how he compares to the compounded yearly results. So if we see limited partners, 22.3%, compared to the Dow, which is at 11.1%, you can see that every single other large money management fund is doing less than the Dow, and the limited partners are kicking butt. Incredible. The repetition of the table says, cause partners to ask why the world does this happen to very intelligent managements working with 1, bright, energetic staff people, 2, virtually unlimited resources, 3, the most extensive business contacts, and 4, literally centuries of aggregate investment experience. The latter qualification brings to mind the fellow who applied for a job and stated he had 20 years of experience, which was corrected by his former employer to read 1 year's experience 20 times. I love that. Okay, this is a good question. Like, why is it that we're, these guys who have so much money on their hands, so much time, so much resources, how could they possibly, with all the resources going on, how could they possibly be doing worse than the Dow? What are your thoughts there?
I mean, he's answered this over and over again. It's he can't expect anything else. I mean, he basically says it's a miracle that they're not significantly worse. It's the environment they're in. They have to manage billions of dollars, and they're punished whenever they deviate too much below Dow.
Mm-hmm.
So all the incentives kind of point towards them having to follow the Dow.
Yeah, but
just because they're big, and that's the incentives of, like, whenever you do poorer than Dow, even though it may be a short-term, scenario, the people will pull out money, and then so instead of taking big, chances and taking risks, kind of just curate something that will keep the money in, and you just take a management fees, and then you just kind of track it out.
So maybe another good way of putting it is, like, their interests are actually in the management fees, not really the returns that they're giving to their shareholders.
Correct.
Yeah. Their incentive is different. So really, the carrot in front of them is different than maybe what's best for the average investor. Yep.
Yeah. And I think they just have so much money. I mean, there are billions of dollars in that time. I mean, they can't possibly go after these smaller companies that Buffett is going after. So
yeah. And they're not as patient, I would think, because I would guess that their investors are looking for returns on a quarterly basis, maybe even yearly basis. Yeah. Okay, let's see what Buffett has to say. This question is of enormous importance, and you would expect to be the subject of considerable study by investment managers and substantial investors. After all, each percentage point on $30 billion is $300 million per year. Curiously enough, there is practically nothing in the literature of Wall Street attracting this problem, and discussion of it is virtually absent in security analysis, society meetings, conventions, seminars, etc. My opinion is that the first job of any investment management organization is to analyze its own techniques and results before pronouncing judgment on the managerial abilities and performance of the other corporate entities of the United States. In the great majority of cases, the lack of performance exceeds or even matching an unmanaged index is in no way reflects lack of either intellectual capacity or integrity. I think it is much more the product of, one, group decisions. My perhaps adjudicated view is that it is close to impossible for outstanding investment management to come from a group of any size with any parties really participating in decisions. Two, a desire to confirm the policies and, to the extent, the portfolios of other large, well-regarded organizations. Three, an institutional framework whereby average is safe and the personal rewards for independent action are in no way incommensurate with the general risk attached to such action. 4, an adherence to certain diversification practices which are irrational, and finally, and importantly, 5 is inertia. Interesting. Maybe let's maybe stop and talk about these 5 points that he thinks are the reasons. So one would be groupthink. So that this is kind of like, a horse in a committee ends up being a camel. That type of concept where you go in thinking that it's going to be something, but really you get talked out of it. Maybe that's usually the case, or maybe one manager thinks it's a good idea and everyone just kind of follows that person. So that's number one. The second is a desire to conform to what's already existent. So then you're not encouraged to try different things. And the third would be you want to play it safe, right? You don't want to put it too much risk. And so maybe that's also the reason why they're not getting as much gains, because they're playing it safe. And then the fourth would be they do things which might be irrational, or maybe just for diversity's sake, they do some things that are maybe not important to the fund. And then 5, inertia. And I'm not sure what he means by inertia here.
I mean, practicing what has been practiced before.
Okay, so no real movement there.
There's no need to change the practice.
Yep. Anything to add here? Do you think he's pretty much covered it? So do you think as a average investor, if you just read 10Ks yourself and then you did, you don't have to worry about groupthink, you don't have to worry about old ways of doing things, would you maybe perform better than these institutions?
I mean, I would like to say no.
Yeah.
But I think it's certainly possible. Because I mean, if I say yes, then I mean, that just says how I think about myself. Like, wow, yeah, I can beat all these people. I'll have to prove to myself that I can, and then I think it's possible. I'll say in order to beat the market, you have to do something different. Certainly, if I continue to follow. Like, if I continue to follow what they do, I'm not going to beat the market. So I have to do something different.
Do you think something different? Sorry. Do you think something different could be copying other value investors that you find pretty respectable?
Absolutely. I mean, that would be my thesis. I mean, like that. Find out people who are beating the market and who are beating these hedge fund managers and clone them, right? Or do the other way around. I mean, and then go the VC route, figure out which people are in the VC area beating the market in the matter of their returns, and then copy them. But you gotta do something different. You can't just buy the index. I mean,
Yeah.
It's also I think not a terrible strategy, and it has perks of being 100% passive, and you really don't have to worry about anything.
Yeah. Makes sense. Yeah, well, I do have an extra question there. What if so there's the one guru route where you just follow and emulate who you respect, and hopefully that'll beat the Dow. What if you invested in different ETFs in different sectors that you think will blow up? For example, you think that the electric vehicle sector is going to become huge, and then you invest in an ETF instead of the S&P 500. Should you expect a gain better than the S&P 500 if that's the case? So a collection of ETFs instead of just one S&P 500.
I mean, all you're doing is exposing yourself to a certain industry more. It just means that you're exposed to more risk and more reward. I guess you're going to be more volatile. So yeah, you could beat them, or you will do poor. I mean, it's hard to say. If it was certain that you will beat them without the risk, then everybody will do it.
Yeah. That's a very good point. And also I think there's something to be said about, like, we don't really have to do everything that a value investor would do, or even just invest in these different ETFs. Pabrai has this great kind of the Forbes article about the free lunch portfolio, where you just invest in these spawners or these a collection of these spawners and these these three kind of types of portfolios, but then it's a collection of them called a free lunch portfolio, then the likelihood of you probably beating the average, the S&P average is higher. So that's also another good strategy as well. So there's multiple ways of beating the market. We don't know which one might be the most successful. Of course, investing in there's risks in both sides. I feel. What if you trusted the wrong guru? What if you bet on the wrong horse for?
I think it's fascinating that the Buffet, talks about the punch card style, where he's like, I mean, the most important thing is be patient, wait for the perfect pitch, and take a shot.
Mm-hmm.
Make 20 bets over your lifetime, and even if like 5 of them do really well, that means a lot of them are not doing well.
Mm-hmm.
As long as you're patient, you think hard, you think long and hard about where you put your money.
Mm-hmm.
Even then, and your success rate is only 25%, you will be very wealthy.
Mm-hmm. So you're saying the winners will completely outperform the losers, and so you wouldn't even think about the losers.
But you have to be picky. You can't be making 3 new investments every year. I mean,
Yep.
you have to make 1 investment every 2 years.
Yep. Yeah, if that, or just add to your position maybe. Yeah.
But I mean, and then of course you never sell. These are businesses that are great, and that that's the cheapest thing is right now, and it's the best investment right now. So you don't diversify necessarily. You know this is a great idea. The price is good.
Mm-hmm.
Back up the truck.
Yep. Makes a lot of sense.
Keep looking. You're not gonna find like millions of opportunities.
Yeah. Interesting. Okay, let's continue. So perhaps the above comments are unjust. Perhaps even our statistical comparisons are unjust. Both our portfolio and method of operation differ substantially from the investment companies and in the table. However, I believe both our partners and their stockholders feel their managements are seeking the same goal: to maximize long-term annual returns, average returns on capital obtainable with the minimum risk of permanent loss, considering with the program of continuous investments in equities. Since we should have common goals, and most partners, as an alternative to their interest in BPL, would probably have their funds invested in media producing results comparable with their investment companies. I feel their performance recorded is meaningful in judging our own results. There is no question that our important service is provided to investors by investment companies, investment advisors, trust departments, etc. This service revolves around attainment of adequate diversification, the preservation of a long-term outlook, and ease of handling investment decisions and mechanics, and most importantly, the avoidance of patiently inferior investment techniques, which seem to entrance some individuals. But all but a few of these organizations did not specifically promise to deliver superior investment performance, although it is perhaps not unreasonable for the public to draw such an inference from their advertised emphasis on professional management. One thing I pledge to you as partners, just as I consider the previously stated performance comparison to be meaningful now, so will I in the future, no matter what the tale unfolds. Correspondingly, I ask that you, if you do not feel such standard to be relevant, register no such disagreement, and suggest other standards which can be applied prospectively rather than retrospectively. One additional thought. I have not included a column for my table for the most widely used investment advisor in the world, Bell Management. People who watch their weight, golf courses, and fuel bills seem to shun quantitative evaluation of their investment management skills, although it involves the most important clients in the world themselves. while it may be of academic interest to evaluate the management accomplishments of Massachusetts Advisors Trust or Lehman Corporation, it is of enormous dollars and cents importance to evaluate objectively the accomplishment of the fellow who is actually handling your money, even if it's you. The question of conservatism. And looking at the table of investment company performance, the question might be asked, yes, but aren't those companies run way more conservatively than your partnership? If you ask that question of an investment company management, they, in absolute honesty, would say that they were more conservative. If you ask the first 100 security analysts you met, I'm sure that a very large majority of them would also answer the investment companies. Answer for the investment companies. I would disagree. I have over 90% of my net worth in BPL, and most of my family have percentages in that area. But of course, that only demonstrates the sincerity of my view, not the validity of it. It is unquestionably true that the investment companies have their money more conservatively invested than we do. The more to many people too many people conventionally indistinguishable from conservatism. In my view, this represents erroneous thinking. Neither a conventional nor an unconventional approach per se is conservative. Truly conservative actions arise from intelligent hypothesis, correct facts, and sound reasoning. These qualities may lead to unconventional acts, but there may be many times when we have led to unorthodoxy. In some corner of the world, they are probably still holding regular meetings on the Flat Earth Society. Interesting. No real additional thoughts. All he's really saying here is, we need a good yardstick. We need to, the reason why they might be more conservative than us might not lead them to better returns. Yeah. Let's keep going unless you have some additional thoughts.
Let's see. Let me scroll down a little more.
Okay. We derive no comfort because important people, vocal people, or great numbers of people agree with us, nor do we derive comfort if they don't. A public opinion poll is no substitute for thought. When we really sit back with a smile on our face, in which we run into situations we can understand, where the facts are ascertainable and clear, and the course of action obvious. In that case, whether other conventional or unconventional, whether others agree or disagree, we feel we are progressing in the same conservative manner. The above may seem highly subjective. It is. You should prefer an objective approach to the question. I do. My suggestion, if you could go down a little bit. My suggestion is as to one rational way to evaluate the conservativeness of past policies in my study performance in declining markets. We have only 3 years of declining markets in our table, and unfortunately, for purposes of this test only, we were all moderate declines. In all 3 of these years, we achieved appreciably better investment returns than any of the more conventional portfolios. Specifically, if those 3 years had occupied in sequence, the cumulative results would have been, wow, negative 9.7 for Tricontinental, Dow is minus 20, Lehman also minus. So everyone's minus except for Buffett, who's plus 45%.
Yeah. What was he talking about? Why is he talking about Bell and AT&T as much?
I think because they might have been huge companies at the time, so I think maybe he got some criticism saying, "Hey, look, you're comparing only against these guys who are managing a lot of money. Why are you not adding on Dow or why are you not adding on Bell or someone who's like
these
killing it
big
right now?"
companies of the blue chips of that era.
Right. Yeah. And so his thing is like, look, we gotta compare yardstick to yardstick here. So really, if we compare against other people who are managing money, um, you know, over the years, you'll still come out on top. Yeah.
Yeah, like we own AT&T, GE, regardless of price.
Yeah. Right. Yeah.
Man, that's like brings like true to today. Like, let's just buy Google and
Yeah. Yeah. Maybe, it's a good thought because it's kind of like saying, hey, look, why are you not investing in these massively superior returns? It's like it's blindly obvious in front of you. And then Buffett is saying, hey, listen, my yardstick is really over years. I don't really care how one company is doing.
yeah.
And I think like he's also maybe getting some criticism saying that you might be too conservative because these guys who are these big players like Bell, these guys are, they're playing it riskier, they're getting rewarded more. You're very similar to echoing what we're seeing today.
Yeah. So basically, it's like, well, I'm conservative, okay. Even though I'm beating it doesn't mean I'm taking risks. I'm being very conservative.
That's right. That's right. I didn't read that last paragraph. Let me see what that was about on the previous page. Okay, we didn't think that this comparison is all important, but we do think it is somewhat relative. We certainly think it makes sense than saying we own, regardless of price, AT&T, General Electric, IBM, and General Motors, and are therefore conservative. In any event, evaluation of the conservatism of any investment program or management, including self-management, should be based upon rational objective standards, and I suggest performance in declining markets to be at least one meaningful test. Okay, interesting. The joys of compounding. Readers of our early annual letters registered discontent at a mere recital of contemporary investment experiences, but instead hungered for the initial stimulation that only could be provided by a depth study of investment strategies spanning the centuries. Hence this section. Our last two excursions into the mythology of financial expertise have revealed that purposely shrewd investments by Isabella, backing the voyage of Columbus, and Francis I, original price of Mona Lisa, boarded on financial lunacy. Apologists for the parties have presented any array of sentimental trivia. Though at all, our compounding tables have not been dented by attack. Nevertheless, one criticism has stung a bit. The charge has been made that the column has acquired a negative tone with only one financial components of history receiving comment. We have been challenged to record on these pages the story of financial perspicacy. I don't even know what that word means. Which will be a benchmark for brilliance down through the ages. One story stands out. This, of course, is the saga of trading acumen etched into history by the Manhattan Indians, which were untold when they unloaded their island to the notorious spendthrift Peter Minuit in 1626. My understanding is that they received $24 net. For this, Minuit received 22.3 square miles, which worked out about 621 million square feet, which, while on the basis of compared sales, it is difficult to arrive at a precise appraisal. A $20 per square foot estimate seems reasonable, given a current land value for that land as $12.5 billion. To the novice, perhaps this sounds like a decent deal. However, the Indians have only had to achieve 6.5 returns. The tribal mutual funds representative would have promised them this. To obtain this last laugh on Minuit at 6.5%, $24, would be $42 billion in 338 years. And if they just managed to squeeze out an extra half point to get 7%, the present value would be $205 billion. Incredible, over the 338 years. So much for that. Some of you may be viewing your investment policies on a shorter term basis. For your convenience, we've included our usual table indicating the gains from compounding $100,000 at various rates. So 4%, 10 years, 20 years, and 30 years. So you can see compared to 4% and 16%, you'd be getting close to $8 million in 30 years compared to $224,000 and 4%. Incredible. So really, we should do nothing but if we say, let's say, we're giving Dow the benefit of the doubt, and then let's say that they give us 12%, and you're a 20-year-old kid and or 30-year-old person, and then at the end of 30 years, you have $3 million in the bank. If you put in $100,000, it's pretty great. Pretty great return. And that's just with the Dow. So you can't help but get rich if you just invest for a long period of time and start early. Okay, this table indicates the financial advantage of a long life. Makes sense. It is erudite vocabulary of the financial sophisticate that this is referred to as the Methuselah technique. Number two, a high compounding rate. Number three, a combination of both, especially recommended by this author. To be observed are the enormous benefits produced by relatively small gains in the annual earnings rate. This expands our altitude, which, while hopeful of achieving a striking margin of superiority over average investments results, nevertheless, regards every percentage point of investment return above average as having real meaning. Our goal is, you will note that there is no columns in the preceding table for 27.7% average as the partnership during the 80-year lifespan, or the 22.3% average of the limited partners. Such figures are nonsensical for the long term for several reasons. Don't worry about me holding back this substantively to substantiate this prophecy. Number one, any significant sum compounded at such rates take a national debt proportions at alarming speed. Number two, during our 80-year history, a general reevaluation of securities has produced average returns of an overall gain from the whole community, from the whole common stock field, which I believe unattainable in future decades. Over a span of 20 to 30 years, I would expect something like 6 to 7% overall annual gain from the Dow instead of the 11.1% in brief history. This factor alone would have tended to knock 4 points or so off of our annual compounding rate. It would only take a minus 20.5% year in 1965 for the Dow to bring down to a 7% average figure in the 9 years. Such years, or worse, should definitely be expected from... Sorry. So this factor alone would knock down 4% or so off of our annual compounding rate. This would take minus 20.5% in 1995, and the Dow bringing down 7% average figure in 9 years. Such years, or worse, should definitely be expressed from time to time by those holdings equity statements. If a 20 to 30% drop in the market value, your equity holdings, such as BPL, is going to produce emotional or financial distress. You should simply avoid common stock type investments. In the words of the poet Harry Truman, if you can't stand the heat, stay out of the kitchen. It is preferable, of course, to consider the problem before you enter the kitchen. Very interesting. We do not consider it possible on an extended basis to maintain 16.6% point average over the Dow, the partnership, or the 11.2% points edge enjoyed by the limited partners. We have had 8 consecutive years in which our pool of money has outperformed the Dow. Although the profit allocation agreement left the limited partnership short of the Dow results, in one of those years, we are certain to have years, note the plural, years, when the partnership results fall short of the Dow, despite considerable garnish of teeth by the general partner. Or, I guess that's jittering of the teeth. I hope not too much of the limited partners, but when when that happens, our average margin of superiority will drop sharply. I might say that I also think we will continue to have some years of very decent margins in our favor. However, to date we have benefited by the fact that we have not had to really we have not had a really mediocre or worse year included in our average, and this obviously cannot be expected to be permanent experience. So what can we expect to achieve? Of course, anything I might say is largely guesswork, and my own investment philosophy has developed around the theory that prophecy reveals far more of the facility, or far more of the frailties of the prophet than it reveals of the future. Nevertheless, you as partners are entitled to know my expectations, tumultuous as they may be. I am hoping that our long-term experience will unfold along the following basis. 1, an overall gain from the Dow, including dividends, of course, averaging the area of 7% per annum, exhibiting customarily wide amplitudes in investing this average, say on the order of minus 40% to plus 50% at the extremes, with the majority of years in the minus 10 to minus 20% range. An average advantage of 10% points per annum for BPL might, before allocation to the general partner, again with large amplitudes in the margin from perhaps 10% points, worse than the Dow, is a bad year to 25% points better when everything clicks. And number 3, the product of those two assumptions gives us an average of 17% to BPL, or about 14% to limited partners. This figure could vary enormously from year to year, the final amplitudes, of course, depending on the interplay of the extreme hypothesized in 1 and 2. Okay, interesting.
What is he saying here? What did you get out of it?
So, what my understanding is that we're going to be down substantially in multiple years compared to the Dow. But if you really ask me to speculate how we'll do in the future, I think these 3 things will happen. On average, we should be getting close to 7%, and then and then the second point is that BPL should be outperforming the market by maybe close to 10%, hopefully. And then the third is that I guess if we do 1 and 2 together, then the hopes should be better returns than the Dow. Is that pretty much it?
Yeah, I think overall he's just trying to manage expectations and I guess still answer some and give them realistically what's going to happen. So it's like, well, 7 to 10, 7 to 10. Well, he's still making like 20%, 30%.
Yeah. I would like to emphasize that the above is conjecture, perhaps heavily influenced by self-interest, ego, etc. Anyone with a sense of financial history knows that sort of guesswork is subject to enormous error. It might be better be left out of this letter, but in the question frequently and legitimately asked by partners, long-range expectable return is the primary consideration of all of us belonging to BPL, and it's reasonable that I should be put on record, foolish as they may later may appear. My rather puritanical view, is that any investment manager, whether operating as a broker, investment counselor, trust department, investment company, etc., should be willing to state unequivocally what he is doing to attempt to accomplish, and how he proposes to measure the extent to which he gets the job done. Our method of operation. In the past annual letters, I have always utilized three categories to describe investment operations we conduct. I now feel that our four-category division is most appropriate. Partially, the addition of a new selection, generals relatively undervalued, reflects my further considerations of essential differences that have always existed to a small extent with our new generals group. Particularly, it reflects the growing importance of what once was a very small subcategory but is now a much more significant part of our total portfolio. This increasing importance has been accompanied by excellent results, to date justifying significant time and effort devoting to find additional opportunities in this area. Finally, it partially reflects the development and implementation of a new and somewhat unique investment technique designed to improve the expectancy and consistency of operations in this category. Therefore, our four present categories are. So I think he's gone through the four before, but maybe he's kind of editing it a little bit.
There were only three before. I'm kind of curious.
Oh yeah, that's right. It was generals, workouts, and what was the third one?
Controls.
Controls. That's right.
But he split generals into two. So let's see what he made.
Yeah. Generals is split into two. Okay. So a general's private owner bias. So category basis. A category of generally undervalued stocks determined by qualitative standards, but with considerable attention also paid to the qualitative factor. There is often little or nothing to indicate immediate market improvement. The issue lack glamour or market sponsorship. Their main qualification is a bargain price, that is, an overall valuation of the enterprise substantially below what careful analysis indicates its value to a private owner to be. Again, let me emphasize that while the quantitative comes first, it is essential the qualitative is important. We like good management. We like a decent industry. We like a certain amount of ferment in a previously dominant market or stockholder group, but we demand value. Many times in this category, we have the desirable two strings to our bow situation where we would either achieve appreciation of market prices for external factors and from the acquisition of a controlling position in a business at a bargain price. While the former happens in the overwhelming majority of cases, the latter represents an insurance policy most investment operations don't have. We have continued to enlarge the positions of the three companies described in our 1964 mid-year report, where we are the largest stakeholders. All three companies are increasing their fundamental value at our very satisfactory rate, and we're completely passive in two situations and active only in one minor scale in the third. It is unlikely that we will ever take really an active part in policy making in any of these three companies, but we stand ready if needed. Okay, let's maybe talk about the first one. So this is these are privately owned businesses which where the real value is based off of quantitative measurements, like how much is it really worth, so book value, and then this is, but of course management also matters, but he says it's primarily based off of book value. Is that how you're reading it?
Yeah, I mean, there are always two aspects to a business, right? You want an amazing business and you want a good price. I think he's kind of doing the Graham thing where he's first looking at the price and then he's also trying to make sure it's not a crappy business.
Mm-hmm.
So that's it. I mean, yeah, he's probably working net so as you can look at book value. I think that's fine. But then he's also trying to make sure the business is decent.
Yep.
So yeah, and it sounds like that he has three businesses that they're the largest shareholder, and probably Berkshire is one of them. That's my understanding.
Yep.
But yeah. So let's see what he means by relatively undervalued.
Yeah, so these are still in the generals category. So this is relatively undervalued generals. This category consists of securities selling at prices relatively cheap compared to securities of the same general quality. We demand substantial dependencies from current valuation standards, but usually because of the large size, we do not feel value to a private owner to be a meaningful concept. It is important in this category, of course, that apples be compared to apples and not to oranges, and we work hard to achieving that end. In the great majority of cases, we simply do not know enough about the industry or company to come to a sensible judgment in that situations we pass. As mentioned earlier, this new category has been growing and has produced very satisfactory results. We have recently begun to implement a technique which gives promise of very substantial reducing the risk of any overall change in valuation standards. Example, I
One.
example one. We buy something at 12 times earnings where comparable or poorer quality companies sell at 20 times earnings. But then a major relative reevaluation takes place, so the latter only sells at 10 times. This risk has always bothered us enormously because of the helpless position in which we could be left compared to the generals, private owners, or workout types. With this kind of risk diminished, we think that this category has promising future. Okay, so let's maybe just quickly talk about this one too. So number two is where he doesn't think that taking a majority ownership of the company is valuable.
Well, not really. I mean, he's just kind of focusing on, before he looked at kind of absolute cheapness.
Uh-huh.
He looked at, well, this company is selling for PE of 5. I mean, that's great. I'm going to buy it. Now he's willing to consider much higher PEs, like 12,
Mm-hmm.
which he wouldn't have otherwise. Granted, similar companies in the industry, are selling for a lot more.
Mm.
So if I mean, kind of like big tech, if big tech is selling at PE of 30, and there's one company that's selling at PE of 15,
Mm-hmm.
even though he wants to buy things at PE of 5, he will still take that PE 15 because relative to its peers, that company is selling for super low. Like, even if there was an industry-wide lowering of PE,
Yeah.
he still feels there's a margin of safety built into that. So that's what he's been doing a lot more. So not look for absolute bargains, but relative bargains.
Interesting. Okay. Very cool.
That's my understanding of it.
Yeah, that makes sense to me. Okay, number three is workouts, and number four is controls. So we know about these, but we can go over it. So number three, workouts. These are the securities with a timetable. They arise from corporate activity, sellouts, mergers, reorganizations, spin-offs, etc. In this category, we are not talking about rumors or inside information pertaining to these developments, but are publicly announced activities of this sort. We wait until we read it in the newspaper, and that the risk pertains only not primarily to general market behavior, although this is sometimes tried to some degree, but instead to something upsetting the apple cart so that the expected development does not materialize. Such joy kills could include antitrust or other negative government actions, stockholder disapproval, withholding of tax ruling, etc. The gross profits in many workouts appear quite small. It's a little like looking for parking meters with some time left on them. However, the predictability coupled with a short holding period produces quite decent average annual returns, rate of returns after allowance for the occasional substantial loss. This category produces more steady absolute profits from year to year than generals do. In years of market decline, it should usually pile up a big edge for us. During bull markets, it will probably be a drag on performance. On a long-term basis, I expect the workouts to achieve the same sort of margin over the Dow attained by generals. Interesting. Okay. That last sentence is a little kind of interesting because he's saying, I expect the workouts to achieve the similar margins over the Dow obtained by generals. So generals and workouts should be giving same percentage returns.
Yeah, I think over the long term, because generally he felt like the Dow, the workouts will give you about 15 to 20%,
Mm-hmm.
and the generals will be more volatile. Generals will give you 30 years in 1 year and maybe like 5 in 1 year.
Mm.
So
Okay.
saying, I think he's saying both of them will kind of give us similar,
Mm.
but over a long period of time, this the workouts are less volatile. They're more predictable. So he even felt safe to borrow money to invest.
Mm.
Whereas generals are have more of an upside that's not realized, and so they may have a little bit of wild card factor where they could give you more than normal return.
Mm. But wait, which one can give you more of the short-term, long burst of return? The workouts, right?
So again, the short term,
So, like, let's say that you found out that there was a workout, so a spin-off of a company, and then boom, the price went up because they're pretty well situated. Is that usually the case? So instead of controls, where it's kind of a substantial, a pretty heavy company, and it's doing well, and it's just
yeah,
undervalued right
workouts are
now.
short term
Yeah.
investments.
Okay.
For
Okay.
sure.
Gotcha. Yep. Okay, number 4, controls. These are rarities, but when they occur, they're likely to be of significant size. Unless we start off with the purchase of a sizable block of stock controls developed from generals, privately owned category. They result from situations where a chief security does nothing price-wise for such an extended period of time that we are able to buy a significant percentage of that company's stock. At that point, we are probably in a position to assume a degree of, or perhaps complete control of the company's activities. Whether we become active or remain relatively passive at this point depends upon our assessment of the company's future and the management capabilities. Interesting. So this would be something like later on where he buys See's Candy, right? So he just buys See's Candy, he knows what to do with the profits, and he takes full ownership of the company and then just uses whatever he wants to redeploy the capital. Yep. Okay, we do not want to get active merely for the sake of being active. Everything else being equal, I would much rather let others do the work. However, when an active role is needed to optimize the employment of capital, you can be sure that we will be standing in the wings. Active or passive, in a control situation, there should be a built-in profit. The sine qua non of this operation is an attractive purchase price. Once control is achieved, the value of our investment is determined by the value of our enterprise, not the oftentimes irrationalities of the marketplace. Any of the 3 situations where we are now the largest stakeholders mentioned under generals, private owner could, by virtue of the two-way stretches they possess into controls. That would suit us fine, but it also suits us if they advertise in the market to a price where in line with intrinsic value, enabling us to sell them, thereby completing a successful general's private owner operation. Investment results in the control category we have measured on the basis of these last several years, basis of at least several years. Proper buying takes time. If needed, strengthening management, redirecting the utilization of capital, perhaps affecting a satisfactory sale or merger, etc. We also all factors are all factors that might be that make this business to be measured in years rather than months. For this reason, in controls, we are looking for wide margins of profit. If it appears at all close, we quit playing. Controls is the buying stage, moved largely in sympathy with the Dow. In the later stages, their behaviors is geared more than that of workouts. You might be interested to know that buyers of our former control situation, Dempster Mill Manufacturing, seems to be doing very well with it. The This fulfills our expectation and is the course of satisfaction. An investment operation that depends on the ultimate buyer making a bomb deal. In Wall Street, they call this the beggar fool theory. Is tedious indeed. How much more satisfactory is it to buy at really bargain prices so that our average disposition brings pleasant returns? As I've mentioned in the past, the division of our portfolio among categories is widely determined by the accident of availability. Therefore, at any given year, the mix between generals, workouts, and controls is largely a matter of chance, and this fickle factor will have a great deal to do with our performance relative to the Dow. This is one of many reasons why a single year's performance of minor importance is a minor importance, and good or bad should never be taken too seriously. To give an example of just how important the accident of division between these categories are, let me cite the example of these 3 past years, whereby the average monthly investment at market value by category is utilized borrowed money and office operational expenses excluded, etc. This gives us the most accurate basis of intergroup companies, but does not reflect overall BPL results. The generals both present categories combined, workouts, and the Dow shape as follow. This is an interesting table. So he's only giving us 3 years here, but he's categorized his companies into generals, workouts, and the Dow. And you can see in some years, workouts is doing better than generals in the Dow, and in other years, the generals are doing better than the workouts. So maybe this distinction between generals and workouts, since he's doing a combination, it outweighs the risk, so he'll still end up doing better than the Dow.
I think it really is. I mean, like, people think like stocks and bonds are like a two thing that you need to balance and use together, diversify.
Mm-hmm.
If you really know what you're doing, this is what you need. You need basically cheap stocks and then workout stocks, and this gives you stability and this gives you gains.
Yep. And what's interesting here is this is almost like Pabrai's free lunch portfolio. You know, he combines all of them, reduces the risk drastically, and he says, hey, look, this is still going to outperform the Dow.
Does he talk about workouts?
Yeah. He calls them spin-offs, but yeah.
Okay, I see. Spin-offs, not spawners, spin-offs.
Yeah, spin-offs.
Okay.
Yeah. But yeah, it's interesting. Maybe the stock and bond thing isn't the best way to categorize. Maybe these ones are better. Yeah. Obviously, the workouts along with controls saved the day in 1962, and if we had taken lightly in this category that year, our final result would have been much poorer, although still quite respectable considering market conditions that year. We could just as well have had a small percentage in the portfolio in workouts that year. Availability declined. Decided it, not the notion on my part as to what the market was going to do. Therefore, it is important to realize that in 1962, we are just plain lucky regarding the mix of categories. In 1963, we had one sensational workout, which greatly influenced results, and generals have a good account of themselves, resulting in a banner year. If workouts had been normal, say more like 1962, we would have had looked much poorer compared to the Dow. Here, it wasn't our mix that did much for us, but rather excellent situations. Finally, in 1964, workouts were a big drag on performance. This will be normal in any event during a big plus year for the Dow, such as 1964, but they were even a higher drag than expected because of mediocre experiences. In retrospect, we would have been pleasant to have been entirely in generals, but we didn't play the game in retrospect. But we don't play the game in retrospect. I hope the preceding table drives home the point that results in a given year are subject to many variables, some regarding which we have little control over or insight. We consider all categories to be good business, and we are very happy we have several to rely on rather than just one. It makes for more discrimination within each category and reduces the chance we will that we will be put completely out of operation by the elimination of opportunities in a single category. Interesting. Yeah. So he can't predict the future. He says, look, sometimes I wish I was general, sometimes I wish I was workouts, but overall, I don't decide it. It's not because of himself that he's saying no to these places. He's just not seeing these opportunities.
And he's really not bothered by what ifs. He's like, well, this is it.
Yeah. Yeah. I love that. Yeah.
It's my goal.
Yeah.
All right, continue.
Taxes. We have had a chorus of groans this year regarding partners' tax liabilities. Of course, where we also might have had a few in the tax sheet had gone out blank. More investment sins are probably committing by otherwise quite intelligent people because of tax considerations than in any other cause. One of my friends, a noted West Coast philanthropher, maintains that a majority of life's errors are caused by forgetting what one is really trying to do. This is certainly the case when an emotionally supercharged element like taxes enters the picture. I have another friend, a noted East Coast philosopher. I don't know why I'm saying philanthropy. Philosopher who says it isn't the lack of representation he minds, it is the taxation. Let's get back to the West Coast. When what is one really trying to do in the investment world? Not pay the least taxes, although that may be a factor in considered in achieving the end, means an end should not be confused, however, and the end is to come away from the largest after-tax rate of compound. Quite obviously, if two courses of action promise equal rates of pre-tax compound, and one involves incurring taxes, and the other doesn't, the latter course is superior. However, we find that this is rarely the case. It is extremely improbable that 20 stocks selected from, say, 3,000 choices are going to prove to be optimum portfolio, both now and a year from now, at the entirely different prices, both for the selections and the alternatives prevailing that later date. If our objective is to produce the maximum after-tax compound rate, we simply have to own the more attractive securities obtainable at current prices. And with 3,000 rather rapidly shifting variables, this must mean change, hopefully tax-generating change. It's obvious that the performance of a stock last year or last month is no reason per se to either own it or to not own it now. It's obvious that an inability to get even in a security that has declined is of no importance. It's obvious that the inner warm glow that results from having held a winter last year is of no importance in making a decision as to whether it belongs in an optimum portfolio this year. If gains are involved, changing portfolios involves paying taxes, except in very unusual cases. I will readily admit that there are some cases. The amount of tax is of minor importance, and the difference in expectable performance is significant. I've never been able to understand why the tax comes as such a body blow to many people, since the rate of long-term capital gains is lower than that than on most lines of endeavor. Tax policy indicates digging ditches is regarded as socially less desirable than shuffling stock certificates. I have a large percentage of pragmatists in the audience, so I had better get off that idealistic kick. There are only three ways to avoid ultimately paying the tax. One, die with the asset, and that's a little too ultimate for me. Even the zealots would have to view this cure, quote unquote, with mixed emotions. Number two, give the asset away. You certainly don't pay any tax this way, but of course you don't pay for any groceries, rent, either. Number three, lose back the gains if your mouth waters at a tax at this tax saver. I have to admire you. You certainly have the courage of your convictions. Yikes! Definitely don't want to do number three. So it is going to continue to be the policy of BPL to try to maximize investment gains, not minimize taxes. We will do our level best to create the maximum revenue for the Treasury at the lowest rates the rules will allow. An interesting sidelight on this whole business of taxes vis-a-vis investment management has applied in this last few years. This has arisen through the creation of so-called swap funds, which are investment companies created by the exchange of the investment companies' shares for general market securities held by potential investors. The dominant sales argument has been the deferment, which pronounced to be an enthusiastic salesman sometimes comes very close phonetically to elimination of capital gains tax while trading a single security for the diversified portfolio. Tax will only finally be paid when the swap fund share are redeemed. For the lucky ones, it will be avoided entirely when any of these delightful alternatives mentioned 2 paragraphs earlier eventualities. The reasoning implicit in the swampy actions is rather interesting. He obviously doesn't really want to hold what he is holding, or he wouldn't jump at the chance to swap it and pay a fairly healthy commission, usually up to $100,000 for grabbing a bag of similar hot potatoes held by other tax-numbered investors. In all fairness, I should point out that after all the offerees have submitted their securities for exchange and had a chance to review the proposed portfolio, they have a chance to back out, but I understand a relatively small portion do so. There we have 12 such funds that I know of, established since the organization of the idea in 1960, and several more are currently in the works. The idea is not without appeal, since sales totaled well over 600 million. All of the funds retain an investment manager to whom they usually pay half or 1% of asset value. This investment manager faces an interesting problem. He is paid to manage the fund intelligently, in each of the 5 largest funds. This fee currently ranges from $250,000 to $700,000 per year, but because the low tax basis inherited from the contributions to securities, virtually his every move creates capital gains tax liabilities. And of course, he knows that if he incurs such liabilities, he is doing so for people who are probably quite sensitive to taxes, or they wouldn't own shares in the swap funds in the first place. I'm putting all of this a bit strongly. I'm sure there are some cases where a swap fund may be the best answer to the individual combined tax and investment problems. Nevertheless, I feel they offer a very interesting test tube to measure the ability of some of the most respected investment advisors when they are trying to manage money without paying significant tax. The 3 largest swap funds were all organized in 1961 and combined have assets now of about $300 million. Of one of these diversification funds reports on a fiscal year basis, which makes extraction of relative data quite difficult for calendar year comparisons. The other 2, Federal Street Fund and Westminster Fund, respectively, first and third largest in the group, are managed by investment advisors who oversee at least $2 billion of industrial money, or institutional money. Here's how they shape up for all full years of existence. So you can see the annual compounded rate for these 3 years. The Dow was 9.8. Wow, these guys really suck.
That's what they. I mean, they're trying to, I guess, maximize low taxes, and that means they don't really make any money. They're probably selling things they don't need to sell just so they can avoid taxes, and buying things they shouldn't be buying just because they can avoid taxes. And end result, they're making no money. They should have
That
just stuck to Dow.
Yeah, that is so fascinating to me because you always hear, two sides of the pipe, right? Like stuff that you feed into it and then stuff that you can take out. And if you feel like you can take out more because you're saving on taxes, you would think that's a no-brainer. But clearly this shows, it's very disadvantageous. You think you're saving a little bit of money on taxes, but you're losing a whole bunch of money. Wow, interesting.
All right, let me finish it.
Yeah.
This is strictly the management record. No allowance has been made for the commission in entering, and any taxes paid by the fund on behalf of the shareholders have been added back to performance. Anyone for taxes? Question mark. All right. So lesson learned: don't worry about taxes. I mean, worry about performance. In the December 21st issue of Automotive News, it was reported that the Ford Motor Company plans to spend $700 million in 1955 to add about 6.7 million square feet to its facility throughout the world. Buffett Partnership Limited never far behind plans to add 227 and a quarter square feet to its facilities in the spring of 1965. Woohoo.
Yay.
Our growth in net assets from one of 105,000. There's no prize for guessing who put in the $100 on May 5th, 1956, when the first predecessor limited partnership, Buffett Associates Limited, was organized to 26 million on
Whoa.
January 1st, 1965, creates uh, the need for an occasional reorganization in internal routine. Therefore, roughly uh, contemporaneously, with the bold move from 682 to 909 and a quarter square feet, a highly capable is going to join our organization with responsibility for the administrative and certain other functions. This move will particularly serve to free up more Bill Scott's time for security analysis, which is his forte. I'll have more to report on this in the mid-year letter. Bill, who continues to do a terrific job, and his wife have an investment in the partnership of about $300,000, a very large majority of their net worth. Our new associate, his name is being withheld until his present employer has replaced him, along with his wife and children, has made an important investment in the partnership. Susie and I presently have an interest of $3.4 million in BPL, which represents virtually our entire net worth, with the exception of our continued holding of Mid Continent Tap Card Company, a local company into which I bought in 1960, which when it had less than 100 stockholders. Additionally, my relatives, consisting of three children, mother, sisters, brother-in-laws, father-in-laws, aunts, cousins, nieces, nephews have interest in BPL directly and indirectly of about $2 million. So we all continue to eat home cooking. We continue to represent the ultimate in seasonal businesses, open one day a year. This creates a real problem in keeping the paper flowing smoothly, but Beth and Donna continue to do an outstanding job of coping with this and other problems. Pete Morwick Michelle has distinguished itself in its usual vile role of finding out what belongs to whom. We continue to throw impossible deadlines at them, and they continue to perform magnificently. You will note in their certificate this year that they have implemented a new procedure whereby they now pounce on us unannounced twice a year in addition to the regular year-end effort. Finally, and most sincerely, let me thank you, partners who cooperate magnificently in getting things. Oops, hold on. You have to finish it. Finish it.
Okay. Okay, so finally and most sincerely, let me thank you, partners who cooperate magnificently in getting things for us promptly and properly, and thereby maximizing the time we can spend working when we should be by the cash register. I'm extremely fortunate in being able to spend the great majority of my time thinking about where our money should be invested rather than getting bogged down in the minute or the minutiae that seems to overwhelm so many business entities. We have an organizational structure which makes the efficiency a possibility, and more importantly, we have a group of partners that make it a reality. For this, I am more appreciative than we are all wealthier. Our past policy has been to admit close relatives of present partners without a minimum capital limitation. This year, a flood of children, grandchildren, etc. appeared, which called this policy into question. Therefore, I have decided to institute a 25,000 minimum on interests of immediate relatives of present partners. Within the coming 2 weeks, you will receive one, a tax letter giving you BPL information needed for your 1964 federal income tax letter. The letter is the only item that counts for tax purposes. Number two, the Audit of Peace, Maxwell, Michelle, and Co. For 1964, setting forth the operation of financial positions of BPL as well as your own capital account. A letter signed by me setting forth the status of your BPL interest on 11/11/65. This is identical with the figure development of the audits. And then number four, Schedule A of the partnership agreement listing with all partners. Let Bill or me know if anything needs clarification. Even when our splendid staff, our growth even with our splendid staff, our growth means that there is more chance of missing letters, overlooked instructions, a name skipped over, a figure transportation, etc. So speak up if you have any questions at all that we might have aired. My next letter might have aired. My next letter will be about July 15th, summarizing the first half of this year. Cordially, Warren E. Buffett. Interesting. So
Again, he doesn't share any insights in
Yeah,
this 10
companies.
plus letter about what he's buying, but
Yeah.
I guess more about his philosophy. I guess he shared how he changed from those three categories to four of the
Yep.
type of investments he makes,
Yeah.
and bragged more about how he's so rich now. So
Yeah, but also he did have a couple of good nuggets about tax saving.
correct, like, or obsessing with tax savings.
Yeah, yeah,
You know,
right.
like, I mean, that those are good philosophical, like, kind of wake you up. Like, hey, like what are you really focusing on?
Yeah, yeah, yeah. Focusing on tax might not be the optimal way of making money. Yep.
Well, that was a long letter.
That was a long letter. Thanks for sticking it out if you did. And until next time, see you in
Until next time.
1965.
All right, can't wait.